All right. Looks like that has started. For purposes of today's webinar, this is Brian Wilson, joined by Henry Howard. Uh, July 11th, already kind of the middle of the summer. So we have some interesting data to walk through today. We thought we would do here at the beginning a little bit of a question and answer format. Just a couple of rules for you who are new. All questions are welcomed. Please, you can hit the chat button anytime and submit your questions. And we usually have a period at the end if you want to actually verbally discuss them. Just rules, just please mute yourself during the discussion, just for the sake of everyone else. With that being said, let's see if there's anyone else that is trying to come in. I think we're good right now. I'll share my screen for just a moment. I wanted to ask Henry a couple of questions here at the beginning, and part of it actually goes back to his discussion yesterday in Wednesday's market desk note. So part of it was right here. Henry was talking about high liquidity, meaningful volatility, upward trending sentiment, declining short volume. So a little bit of a process that he was unpacking. And I wonder, Henry, if you could just for a moment just elaborate a little bit on that process. And if you want to share your screen, please feel free to do so.
Yeah, absolutely. So welcome everyone. My name's Henry. I've been learning a lot from Brian Wilson and Tim Quast for the last 3 years. And so, yeah, what I wanted to look at is, to Brian's point, as I pull this up, there's really early on in the days of Edge, we were looking at, like, one thing that we need as traders is we need liquidity. It doesn't help us if we're trying to get into a significant position and we can't get in and out of it. And so that's a metric that, we have dollar per trade. So we can find things that have big liquidity that we know we can get in and out of. That's important to me as a trader. So let me, the next one, and help me out, Brian, is, rising demand. And so, now we currently have our momentum portfolio, and that's sort of, to a degree, the best of the best that are tens. But what I'm really looking for is that movement upward. Some of the, if I look at the tens right now, some of these tens, they'll stay in this portfolio for longer than I like them to stay in that portfolio. So I like to find a name that's hitting 10 on its way up, not when it's been sitting in our momentum portfolio for 10 days. And then Brian, remind me what the next two. So that goes to upward trending. Stocks
Yeah,
are
so
moving.
we were talking about liquidity and volatility, upward trending sentiment, and declining short volumes.
So again, that is it's our momentum portfolio. It's a volatility that's over 3. So I know that I'm not going to be sitting for this like 0.5% name that's just not moving. Like, I need some volatility, I need some movement to make money. And then the last part is looking at this. So I said dollar per trade. The last part is looking at this supply trend. Obviously you can look here and you can look at supply up or down, but a lot of the time I like to think about supply trend as like the relative supply. So today, let's go just off the top of my head. Let's go look at, I spent a lot of time in big tech. Everybody I think knows that by now. But let's go look at something I wanted to point out last week in Tesla. So, Tesla here, if we drop this down, Tesla supply at 65%, that doesn't seem all that abnormal to me for Tesla, right, Brian? It spends its time up there, but relatively, we know that it can go down. If we look at 52%, like 65 is high, but it doesn't actually mean that the price is gonna go down. the point I made last week, and this goes back to like declining short volume, is I like to find if we have that divergence, that upward demand and that declining supply, I have high liquidity. Those are like, from an individual stock perspective, those are things that I really like. What I mentioned last week in my note, Brian, was so if we look at Tesla, look at Tesla's short volume. Actually, demand is flat. Short volume is going from 52 to 55, 57, all the way up to 65. Well, look at where the price went, even while we had 64% short volume.
Mhm. And
I mean,
and to your
yeah.
point there, Henry, every stock can have its own, let's call it short volume norms. And sometimes short volumes can, like Tesla here, that's just the way it trades. It's a great point. Just because you see something that looks a little out of whack, take a look at that trend line over time. That trend line, especially here with Tesla, uh, has more to do with whether the short volume is actually below 50% or what have you. I mean, that's the normal central tendency, but every stock can deviate a little bit from that.
Yeah, and that's my big takeaway. I mentioned that I short sold in 2022 quite a bit, and I would find things, and I would look at something like on early part of July at 65%, 65% short volume. I go, man, this thing's gonna slam. Like, and all of a sudden you get surprised because either this short volume gets covered, or this trend just keeps going. Like it just keeps going up, and it's really difficult to catch that. My point being is, when we see high short volumes, it's not necessarily a measure of people or activity in the market that's anticipating a decline. A lot of that short volume is actually just perceiving risk. So whether that risk formulates into lower prices or not, we can't always rely on short volume entirely to say, oh, well, the stock's going to go down or the stock's going to go up. Um, Short volume is oftentimes just a perception of risk that's forthcoming in CPI and PPI and expirations in Fed remarks. All of that is bundled into not individuals, but passive money, long short money that's hedging itself, so that it doesn't lose its, say you have 30% of your portfolio in Tesla because you bought it down here. Well, you're going to start hedging because you want to keep your money, but you still maybe want to keep you want to hold that position. So I'm going to say it one last time. Short volume is not an anticipation of a price deterioration. It is the expectation of risk and the perception of risk in the market. Okay. That's all I'll say.
No,
Well, I'm
it's a good point. And at times it can literally just point to borrowing of shares. It's the meme stock effect. It's why you can have trading in GameStop and other ones like that, where there's just a sudden borrowing of shares to facilitate that trading. From a big picture perspective, what you would love to see with Tesla right now, just to continue with that example, is you would love for some of these shorts to get covered at higher prices. That would perhaps be a signal that Tesla's ready to continue to move higher.
Yeah, exactly. So Brian, back to the those four components that we mentioned was rising demand, falling short volume, good liquidity, and the fourth is I need your help, Brian,
Sorry,
because it's
look at
not.
let me look at the question. Liquidity, volatility, sentiment, and short volumes.
Yeah, sorry, volatility is something that's going to move. All of that is predicated though on broad market risk, and so something we'll touch on a little bit more is this short volume. But I'll let you get to your next question, Brian.
Sure, thank you.
That can lead us.
Appreciate it. The next one had to do with different behaviors in the marketplace. And in your note yesterday, you briefly mentioned fast traders. And I guess my question is whether you have a favorite behavior that you follow with your trading. You know, i.e., if such and such behavior is a buyer, then I have a pretty good idea that, that my buy orders are going to work. If you understand where I'm
Yeah,
going with
yeah,
that.
yeah, exactly. And so I'll jump back here. I want to take us to a heat map of the S&P. In mentioning Tesla, it's going up and up and up, and you don't quite know when the reversal might take place. That short volume still staying high. You actually might, you've seen it as a 10 for 7 days or whatever. And well, if it was 2 days ago when you tried to sell it short, or you decided to offload your position, you missed out on some significant upward momentum. What I like to look at as we look in this big tech portfolio is these behaviors. And so, Tim could give us the exact numbers, but the vast majority of trading activity that Edge measures is in passive money. So again, it's those funds that they're just benchmarking, and that tends to be the buying and selling activity. And then you get into these, sort of, they're not even niche. It's a smaller portion. I want to say fast trading is like 30% or even 20%. Is that right, Brian? Do you know those
It
numbers off the top of your head?
it's fast trading is actually up at about 50% of daily trading. Once again, when we're talking about fast trading, we're looking for the Citadels of the world, or what have you, that are just looking to go in and out at on a particular day. They're either posting bids or offers, or they're just trading along with whatever the trend might be that day, but they're hoping to get flat by day's end.
Right. So they're setting prices in the market and they're not looking to buy it, but that won't always show up in our behaviors. The passive, even though it's 50%, the rising and declining won't show up in our portfolios. What will show up is that leading behavior in individual names. So, as a contrary to what I'm looking at right now, say this is 80% passive behavior. I look at that, and if broad market is moving upward and these short volumes are low, I'm saying the passive money, maybe it's a new month, new money sort of trade, or even the rebalancing at the end of the month. I'm looking at passive money is still dominating in these big names. So that to me is a continuation move. Um, the thing I mentioned on Wednesday is, look at these names. I think it was 6 out of 11 of the names had fast trading. We'll look again today, and we see that it's 7 out of 11. I look at active as active again is not a significant amount of trading behavior. So the moment active is leading, that tells me more. I like to see this at I'd like to see 9 out of 11 or 10 out of 11 as fast trading. That to me, when short volume is declining, especially 5.5 and below, that to me is a signal that this move is not lasting. So that's kind of how I see fast trading. And so I'll see these names start to populate in fast trading. Say it was only 50% of this portfolio. I don't see that as significant. But when I see 6 of these all move as fast trading, and they're the biggest names in the market, I say, well, they're probably setting prices and they're probably consuming liquidity so they can reset prices the way that they want to. So going to the opposite of that is seeing a prevalence of active and passive money coming into the market at more of, like, say we've been selling off for 2 weeks or 3 weeks, and it's this more significant downward trend, and our sentiments getting to 4.5 or 4.4 or 4.2. I'm not jumping into that declining sentiment until I start to see, oh, now there's 4 names that are active and 4 names that are passive. Oh, now I see that there's 6 names that are active and the rest are passive. Now I recognize that money is beginning to flow in because active money is searching for value in the market. They're buying predicated on price. And so that's, as a general rule, and sometimes it's all predicated on demand, on broad market sentiment. Um, though it tends to be fast trading, I'm looking to get out of my position, and this is sort of broadly speaking. A lot of passive money, I'm looking for a continuation, and if we're on a decline and the market's selling off, for a handful of days or weeks, I'm looking for that turn in sentiment. And I think we're actually going to, before we see that turn in sentiment and price, we're going to see the behavior of active traders and the behavior of passive funds putting money at strategic prices, at prices that they think are either at the average or at a value. So that's how I see behavior.
That's great, Henry. To perhaps add to your comments, if you look at the behaviors right now in big tech, you see that they're being dominated by fast traders. Now, can a fast trading rally continue? Absolutely, it can. You will get periods where you can have essentially a fast trading momentum rally. Once again, it's machine driven trading. They're looking at things on a tick by tick basis, and they're detecting the trends in the market. If those trends are not changing, they will continue with what's working with them for them until it doesn't. But I think to Henry's point, um, it can be a very speculative rally, if that's a good word, where they're taking shares higher. But as you can see right now, there's not a lot of investor activity here, behind the tech trade right now.
Right. Well, and that's, the difficulty is, so, if we look at the price of SPY, um, I'm just going to pull it up very quickly. Do you get in? We'll put it on a 5-day here. Do you short it at the close at 557, or can you suffer through 561? And what I see with the data release, when I saw that data release now, that's like, I took a position at the close of yesterday, and then seeing where the market was, that push higher at the data release, was able to add to it. But I'm only looking for a little section of this, really. But to that point, we're not necessarily trying to find the exact moment, but the prevalence of fast trading, to me, says that those prices are unsustainable. Those prices
Mhm.
won't hold. And it gives me, at the opening, if you're down, your position is negative, I'm not going to cut that loose knowing that fast trading is ticking up and we have declining short volumes. It gives me confidence, really, to hold on to that red trade,
Mhm. Mhm.
before I dump it. So
Perfect. We're going to stop here for just a second, Henry. We've had a couple of questions come in. Um, Steve, I'll start with your question. I don't know for sure whether an ETF can cancel a scheduled reverse split. I'll try to do a little bit of research on that and email you back in regards to that. So not
That
sure in regards to your question, but I'll circle back to you. Let me just make a note of that.
that would be great. Thank you.
Yeah, yeah, absolutely. And question from JLM, would it be possible to talk through an example of how you would use a stock from the momentum portfolio and trade in expirations call? So I'll go ahead and share my screen. We'll be doing this live. I haven't even taken a peek at this, so we'll just kind of walk through this exercise together. So let's say that you were looking at, let's say we're looking at AMD as an example. Um, we'll pull that up and look at. I was looking at the queues, the options chain before the call. I might get to that here a little bit later. But if you look at AMD, and if you're looking at expirations, that's going to be next week for the regular expirations activity. If you were looking at the setup for AMD right now, it depends how you want to trade it. Let's go back to the entry points. Our Entry low is 180.63. Entry high is about 186. Part of it depends on how much you want to pay for a premium. If you look at, let's say, for example, that 185 call, if you're comfortable, paying over $3, for that contract, that's probably a pretty appealing contract. It's obviously in the momentum portfolio. You're looking for it to regain most of what it's lost today. Could that happen? Certainly. Could we have a continuation of the weakness that we're seeing so far today? Yes, that could occur as well. So with any, uh, obviously any options contracts, you have to be willing to, you know, either lose the whole thing or certainly lose a portion of that. So, Henry and I had a discussion a couple of weeks ago. When I do some of these options trades, they would be more of my, medium sized positions. I'm not betting the farm on them, but, just as an example from the momentum portfolio, if you really liked AMD, that might be an example. If you want to go further down the chain and not spend as much money, maybe you do the 190 call, just looking for it to regain, $4 or $5, and that would probably make you some money in the next couple of days. So hopefully that helps, but that's kind of how I would approach that type of trading. I'll stop sharing here for a second. Henry, did you have anything else to add to that?
No, that was an excellent example, Brian. Thank you.
Okay.
That was really good.
Momentum portfolio. When do the stocks first hit that portfolio? I'll take you behind the scenes here for a moment. Let me go ahead and pull it up. So before I share my screen. And I kind of, Henry and I had this discussion with Chris, one of our users here, just a couple of days ago. So let me go back and share my screen now. You'll be able to see the parameters. So this is our momentum portfolio itself. This is the parameters that it's following. And sorry, let me circle back to the exact question. When do the stocks first hit that portfolio? Because it seems like price is never at that low entry. Part of what it's measuring, it's looking for market structure sentiment that is moving higher, supply and demand divergence greater than 1, volatility greater than 3. Sentiment is going to be greater or equal than 8. So you're not catching the very beginning of a rise when you have momentum names. You're catching it as it's further along in the cycle, if that makes sense. So you want to. So as an example, and I'm just making this up. Let's say that AMD was rising from oversold sentiment, and it had been rising for a week and a half or so from a 1, and now it's up to an 8. You're like, well, why didn't momentum catch it at the beginning? Well, that's not the purpose of the momentum portfolio. It is catching names that are a little further along, in that progression. Henry and I are happy to touch base with you. If you do want to set up portfolios that perhaps would catch names a little earlier. The risk that you face with catching names earlier is you never know whether there's going to be follow through or not. And what I mean by that is if you have, let's say that you have a portfolio that catches names rising from 5, and a name starts to rise from 5, and you buy it, and suddenly that demand peters out, and then it starts falling back down again. So this portfolio itself is catching those names that do have a little bit more momentum, as it says by the name itself. In terms of other things, why it might not catch other names, look at the volatility here in the momentum portfolio. I think that's part of the reason why sometimes you won't see some of the Microsofts or Apples of the world. They tend to have volatility actually less than 3. So this is actually a portfolio that's looking for greater volatility, and it's looking for sentiment that is pretty strong. So hopefully that helps in terms of, why we don't catch some of those names at the very beginning. Hopefully that makes sense. Um, okay, I think we caught that. Coming up on 1 o'clock. Henry, let me see
Hey,
if
hey, I'm
Ryan,
here.
we have a new guest
I-
to our chat, and he has a very nice jacket and is
I-
better dressed than either of us. So I think we should let him talk.
I'm kind of embarrassed that, so when I'm doing these normally, I'm not putting a jacket on for you guys, so then I go talk to this other audience and I realize that could be discriminatory. I may have to wear a jacket from here on. So sorry that I wasn't here earlier. I have I belong to this, so does Brian, professional association called NERI, which is the Association for Professional or for Investor Relations. I pointed out when I was on the board and they were contemplating that tagline that the acronym is AIR, that I didn't think that was a wise choice. The Association for Investor Relations. I belong to AIR. Yeah, but anyway, so I had a webinar to do there. By the way, I was talking to IR people about removing arbitrage data from earnings releases because machines move prices. That you have to think about what you communicate to the market, not in terms of reaching stock pickers, but how are machines going to consume this? And does it get you booted from the passive basket? Because you want to remain in the basket and dampen volatility. And you'd say, Quast, we're trying to promote volatility so that we can capture it. Well, there are two different perspectives. But anyway, that's where I was, and I just finished that. I wanted to show up because I wanted to pass along. I made 3 notes here because I know it's been challenging to look. I do all the same stuff you do, and I all the same as I never lose money. I'm not going to lose money on things because the data are very effective for me. I mean, I could give you a case in point today. I owned EQNR, UDR, and CPRT before the market. So one of those, and I look at the supply demand balance today, and already there were a couple of those that were changing. So CPRT, got rid of it, dead level, didn't make any money on it. EQNR, last a little bit. No, EQNR, yeah. And then UDR made a very nice 2% on that. Boom, just like that. So my point is, it always works for me. It's just that you say, well, you look at the broad measures and they just keep going up and till today. And you're trying to trade momentum and low volatility, and it seems very challenging. And it's because of the fact that what happens? It's the point of watching broad sentiment. If broad sentiment deteriorates, the only thing you can trade is tech till it gets to 5. You should be out of tech even then. Right? Even tech is not going to save the market at 5.0. So I closed out of my trades and I immediately shorted the market. And that worked awesome, right? I had a really nice day today. And then you just have to be happy. Just be happy with it and wait for the next thing. The data are not wrong. They're not lying to you. It works. You just have to be very aware of those things. And I think the biggest thing is broad sentiment. If you begin to struggle, always look at broad sentiment. Is it deteriorating? It's going to be harder. Go trade tech. Trade where all of the money is going to concentrate, and don't buy into this argument that the market's going to broaden out. No, it does not. The BlackRock, Vanguard, and State Street do not broaden out. They only settle for worse collateral, and then they start selling the good stuff, and that takes the NASDAQ down 300 points. So the principles still apply. Every day, look at broad sentiment, and the trade in low momentum and low volatility. You're not going to lose money. Just make sure you have you're watching the data and you have your stops and limits in. And if you stop making money, shift to big tech. Then I'm repeating myself for emphasis that once broad sentiment gets to 4.9 today, what happened? Tough day. Sure, we could point to all kinds of things. You could say, well, the market shot up yesterday because, Jay Powell basically said, we're going to cut rates. And then the market pulls back today because all of the gains are baked in. You can come up with whatever you want, but the things that were already there before all of that is the data, are the data. So, is that helpful? It's, if you want to have a candid discussion, feel free. If you've been struggling, let me know. Just go back to those basics. That's the key. Comments? Surely, Steve Hicks, you've got Barry Bailey. Joel, you've got a comment, no?
Tim, I just want to know what price you got on SPY when you short. Did you use SPXU?
Yes.
Okay.
Yep. I think I bought it at 26.38 and I sold it at 27, something like that. I mean, and I bought a lot of it. I bought like 1,000 shares of it, right? So just
right, but it's just quick. You're only in for you're in for that chunk, right?
I was in until the market went down, 89 basis points, because I was like very close to 1%. Right. I don't know which way it's going to go now. I can't predict what it's going to do. I'll take what the market will give me. It will give me that. Remember, always come back to that 1%, 1%, 2%, 3%. Momentum moves 3. The basket moves 2. The big broad measures move 1. And by the way, broad measures moved all of their volatility yesterday, 1%. What is the probability they duplicate that? A number approaching 0, because everybody's on the wrong side of that trade now. So you can always use all that stuff to your advantage, Yeah, Henry, I was in that trade for 45 minutes. That's all.
Right, just looking for it to go green nicely. Will you, to balance out that perspective? I mean, that was one in a set of 10 days where you were certain, right, that like I'm loading this boat today because I know these prices were screaming through the roof on negligence and a sentiment that's now below 5, right? And then the next options. 10 days, we kind of have to see what happens. Like we could get long in the next 10 days. It doesn't mean that this move, and that's why we just take 1% at a time.
Exactly. So, context. The inflation data was already out. No options expiring. Earnings season beginning, but barely. There are 360 companies reporting today, but a lot of them are schlock. That's not meaningful. Options expire next week. The market, all that stuff moved 1%, and broad sentiment hit 4.9. What's the probability of a successful short? Very high, right? 90% probability you're going to be right. But you can't hang on to it. It could be very short-lived, because 4.9 is not far off of dead level, right? Yeah. And supply has fallen. I mean, would I stay in a short if it went 4.9 and we'd seen supply shoot up? Oh yeah, I'd probably shorted it even bigger. But it, can't do that. Yep.
Yeah. I'll share a couple of things here in terms of that 4.9 figure and kind of a look ahead as it were. Let me shift over here for a second. This is a slide deck that we share with some of our on the IR side. And this is what I think is happening today. It's basically just tax consequences. Tech has had such a huge move up. I think we're getting some in-kind redemptions today. So in other words, tech has been moving higher. You get the plan managers that then toss tech into the redemption baskets, and down, tech goes. Could you have an argument that something fundamental changed today? Are the interest rate sensitive stocks, will they now benefit from a rate cut? Maybe, I don't know. But, I think this is what's occurring, is that you get these redemption consequences. Now, what we'll want to watch is whether this trade persists or not. If you look at big tech right now, it's still very, very strong. You look at sentiment, that sentiment is screaming higher. Now, to Henry's point earlier, much of that is fast trading right now. So could it be a little bit frothy? Sure, absolutely. But you still have sentiment that is extremely high. In other words, my argument would be this might be just a one-day decline for tech, and they might resume leadership again. I don't know. we'll have to see, what the data hold tomorrow. One other point here for you, and I was looking at this earlier. It's why I had the triple Qs up. If you look at the Qs right now, extreme weakness in Nasdaq stocks today. Let me see where we're at right now. uh, down 1.7%. That number was north of two a little earlier. A lot of money flowing into the Russell 2000. But if you look at the triple Qs, that setup. Let me enlarge this. That setup is actually pretty good. Sentiment is higher. Short volumes are actually moving below trend. That's why I had the triple Qs up. I was looking at it as a possible buy order for an options trade. If it continues to recover, I probably won't place that trade. But my point being, it's actually a pretty good setup for the Qs right now. I don't know if anything fundamental changed today. I don't think it did. A lot of this information was out already. I think what we're seeing is, once again, right here, we're just seeing the consequences of in-kind redemptions in the marketplace and how that brings down some of the high flyers for a period of time.
And let me just hold on, Tiago. I'm just replying to you here, and I want to just explain that tax consequence in case it doesn't make sense, because it's an important thing to know about ETFs. So Tiago, let me just answer your question. You said you bought some names like Nutanix and Roku, and now they're in the red today. Of course they are. So to me the best thing is have a 1% stop on it. But no, they could absolutely bounce tomorrow. They absolutely could. I mean, again, if the market goes down all of its volatility again today, all other things being equal, particularly if demand stops falling, which it might, all of a sudden you get all that 1% back, and the momentum stocks like Nutanix and Roku could move 3 or 4. So I would play it out tomorrow. I'd certainly check I want to look at the supply demand balance in those things tomorrow morning, and if supply has moved up sharply, then be ready to go. If you recover your losses, get rid of them, right? Don't hang on to it. If you get back to level and then we get greedy. That's what happens. You're like, okay, this demand has started to fall, supply has risen, and then my stock bounces all the way back and I'm level, and you go, oh, maybe I'll make 2% on that. No, don't do it. Just get rid of it. Move on to the next thing. It's much better to do that, right? There's always another thing to trade. There's always the market. There's always momentum or low volatility. And sometimes you should just wait. I mean, there are times when I just sit on my hands because that's better. To the in-kind exchange, here's the key thing. ETF, BlackRock, you and I can't. You and I will pay the gains on the ETF shares that we own in a taxable account. BlackRock does not. BlackRock unloads the tax consequence because they use effectively the 1986 1031 like-kind exchange rules when they create and redeem baskets of equities. So they take a basket of stocks that hold NVIDIA at all, and they give them to, say, Morgan Stanley, and say, we'll take an equal amount of collateral in return. And so Morgan Stanley gives them a check for the value of that basket. I'm just using that term. They could take cash in lieu, could be a basket of stocks that Morgan Stanley, that could do it too. If Morgan Stanley takes a bunch of undervalued Russell 2000 stocks out of the market, goes up and scoops them up, maybe internalizes trades and says, hey, we have a basket of a bunch of junk stocks for you, then BlackRock suddenly gets those, and Morgan Stanley turns around and dumps NVIDIA, which plunges, and then the Russell 2000 shoots up because Morgan Stanley just took all that supply out. That's how that stuff works. And there was no tax consequence for BlackRock. That's how you wash out capital gains with the creation redemption basket. Who explained that to me? BlackRock explained that to me. So it works.
Yeah.
Anyway, we chewed up our time. Yeah.
I still remember a conversation, Tim, that one of our employees had at a conference, and he was with, I'll say it was BlackRock. I don't know. I forget who it was. And he was talking to them during a coffee break. And the guy mentioned to him, he's like, you see that coffee cup over there? we would accept that coffee cup as good collateral. It was just kind of a joke, but the premise was
Right.
the same, that they will accept lots of things as collateral. I did want to share one additional item here as we kind of get ready to close, kind of the path ahead. And we had mentioned it earlier, we're right there at that 4.9. This is some data that I keep, and this was an idea from John Cook. Thank you. But I've incorporated this and kind of look at it every day. But if you look at what's happening right now, this is S&P 500. These are the percentage of stocks that are bottoming right now. These are companies that are moving down, moving up, etc. And what stands out to me right now is you have an awful lot of companies that are currently bottoming, right around 4.8, 4.9. This is our daily read. This is what you see on Market Structure Edge. The point here is that with so many companies bottoming, it would not surprise me if we rose again above 5, even with today's weakness. Now, we're very data dependent. That's a good thing. We'll look at the data tomorrow and we'll see if it changed. If it didn't, that'll be a pretty good signal that maybe this was short-term, short-lived weakness.
Good.
There's only been one time that we've gone below 4 and then not gone back up since 2012 in broad sentiment data.
And was that during the pandemic?
Nope, 2015.
2015, which was a bad year. Yeah.
Yep.
That was Euro crisis number 2.
The other thing I will toss out there is fast trading has been the lead behavior for the last 6 days. We were up 6 days in a row, and the volume was low. So, and it ran up on tech. So I'm not surprised that we had a little bit of this is a bit of an extreme reversion, but it's interesting to see. I'm not surprised that we came off. Everything that I saw we're way outside we were 2 standard deviations above the 20-day median price. So I'm not surprised we came back a little bit.
Yeah. Well, it'll be interesting to see how this.
Yeah. Was that like true investment, or was that just active, running it up on low volume, which is what Citadel tends to do, right?
Mm-hmm.
Yep. To see if people follow, and they do, and then they're gone, and you're left holding the bag. Yep. Yeah. On that happy note, we'll wrap up because we kept you long enough.